An era of significant interest rate cuts is on the horizon. And this era concerns each and every one of us here. The probability that the Federal Reserve will restart interest rate cuts in September is extremely high. Once the Fed initiates another round of interest rate cuts after September, global asset prices will be reshaped. This will have a huge impact on U.S. Treasury bonds, gold, as well as China's real estate market and stock market. We are about to enter a global low-interest rate era, not just a low-interest rate period in China. Ladies and gentlemen, this is of utmost importance. If you own real estate, have savings, stocks, foreign exchange, or gold, you must pay attention to this news. If you don't even care about the Fed's interest rate cuts, you're bound to be exploited, and you'll be completely in the dark about the future direction of asset preservation. Alright, everyone, let me analyze it step by step. Don't blink and keep up with my analysis. The first question is, why will the Fed restart interest rate cuts in September? If you often watch news short videos, you should know that two domestic indicators in the U.S. mainly determine whether the Fed will cut interest rates. The first is employment, and the second is inflation. This is basic financial knowledge. There are indeed no signs of a rebound in U.S. inflation, which hovers around 2%. With such low inflation, the U.S. meets the conditions for an interest rate cut. The other indicator is employment. After June, the U.S. employment data has deteriorated, and there is an urgent need to cut interest rates to stimulate the economy and boost employment. These are the two crucial indicators for deciding whether the U.S. will cut interest rates next. In September this year, both indicators meet the requirements. Moreover, the Fed's interest rate cut in September is just the beginning. By 2026, the Fed will enter a phase of aggressive interest rate cuts, with the amplitude and frequency of rate cuts increasing significantly. Morgan Stanley has predicted that there will be 7 interest rate cuts in 2026, and the U.S. is likely to cut rates by 150 basis points, that is, 1.5%. The expectation of U.S. interest rate cuts is extremely urgent because the U.S. debt is currently very high, and it is of great significance for the U.S. to ease its debt. Let me give you some figures so you can get a real sense of it. The U.S. national debt balance is approaching $37 trillion. If the annual interest rate can be reduced by 2%, it is estimated that the U.S. will save approximately $750 billion in interest. You know how much the U.S. spends in a year, and its annual military expenditure is only about $1 trillion. If the Fed can cut interest rates 7 to 8 times in the next year and a half, by the end of 2026, the U.S. debt will be significantly alleviated. At that time, the global asset price trends will be reshaped, and the yield of U.S. Treasury bonds will definitely decline. You may not know that since 2022, there has been a very crucial financial indicator between China and the U.S., which is the 10-year Treasury bond. This indicator is extremely important. The gap in the 10-year Treasury bond yields between China and the U.S. has widened significantly. The yield of the U.S. 10-year Treasury bond has reached 4.65%, while that of China is only 1.65%. This means that the U.S. interest rate is about 3 percentage points higher than China's, and the spread is twice that of China's 1.65%. In this situation, there will be an effect and a trend where a large amount of capital will flow from China to the U.S. because investors will pursue the certain, safe, and high-interest U.S. Treasury bonds. The following graph compares the trends of the 10-year Treasury bond yields of the U.S. and China. The orange line represents the U.S., and the blue line represents China. The 10-year Treasury bond yield, the anchor of interest rates and assets, has a huge impact. Normally, the interest rates of developing countries with foreign exchange controls are generally a bit higher. For a long time in the past, China's benchmark interest rate was about 80 basis points higher than that of the U.S., and so was the 10-year Treasury bond yield. But what about now? After 2020, China and the U.S. adopted completely different strategies after the pandemic. Since then, China has entered deflation, while the U.S. has faced inflation. The interest rates of the two countries have deviated significantly, creating a huge spread. The yield of the U.S. 10-year Treasury bond, the current interest rate anchor of the U.S., has exceeded 4.5%. If someone had told you a few years ago that the yields of the 10-year Treasury bonds of China and the U.S. could be inverted to the current level, I'm sure you wouldn't have believed it, and neither would I. Because this situation will inevitably lead to a large-scale outflow of capital, currency depreciation, and a large amount of the rich people's money will flee. However, now it has become a reality. If it weren't for China's foreign exchange control policy, Brother Xin, can tell you that China's exchange rate would have depreciated significantly. Fortunately, China has foreign exchange controls and $3 trillion in foreign exchange reserves. The strict foreign exchange control makes it difficult for the rich to move their money out, which is why the current currency depreciation in China is not very obvious. But now, many mainland residents are also changing their behavior. They are going to Hong Kong to deposit money, buy U.S. Treasury bonds, and purchase Hong Kong savings products. Don't you understand what this means? Smart people are now going to Hong Kong to seek high returns. Think carefully. If the U.S. doesn't cut interest rates now, the outflow of our capital will be even more severe. Now is the best time to buy U.S. Treasury bonds and Hong Kong savings insurance. Why? Because starting next year, if the Fed makes aggressive interest rate cuts, all the high interest rate asset dividends of U.S. Treasury bonds, Hong Kong savings insurance, and U.S. dollar-denominated wealth management products centered around U.S. Treasury bonds will disappear. The yields of U.S. Treasury bonds, Hong Kong certificates of deposit, and savings insurance will continue to decline, and there won't be such high returns as in 2025. The current interest rate difference between China and the U.S. gives all of us ordinary people an opportunity called arbitrage. In the past 2 or 3 years, the amplitude of China's interest rate cuts has been relatively small. Especially this year, the interest rate has only been cut by 10 basis points. Why? Mainly because if China continues to cut interest rates, the interest rate gap between China and the U.S. will continue to widen. Now, there is finally a glimmer of hope. If the U.S. starts a new round of interest rate cut cycle in September next month, China will soon follow suit. And once the Fed makes aggressive interest rate cuts next year, we will definitely follow. At that stage, we will enter an era of zero interest rates, and the high interest rate asset dividends in the U.S. will disappear. Will the logic of all assets change? By all assets, I mean including gold and U.S. Treasury bonds. These will all be reshaped according to the logic of the Fed's interest rate cuts. Then, China will accelerate its entry into the zero interest rate era. Everyone's deposits will earn less and less interest and will continue to depreciate. Your cash will enter a rapid depreciation channel. And those who buy real estate and stocks, especially in China's real estate market and stock market, will enjoy a wave of benefits as the Fed cuts interest rates. This is extremely beneficial. If you want to convert your money into U.S. dollar assets and lock in high-interest U.S. dollar returns, let me give you a very reliable piece of advice. Try to lock in high-return opportunities such as U.S. dollar certificates of deposit, U.S. Treasury bonds, Hong Kong savings insurance, U.S. dollar wealth management products, and U.S. bonds within the next 16 months. This may be a once-in-a-lifetime opportunity. Think carefully about what I've said. This video is very logical and important. It basically points out the direction for all those who make low to medium risk investments. Please keep up with my train of thought. Give me a like. I'll tell you how to understand the future direction of wealth. If you haven't understood, please save this video and watch it twice. Share it with your friends who are into financial management and real estate investment. Let's learn together and understand it thoroughly. This is extremely important.